Joining me now is Stephen Wilmot, car columnist for the Wall Street Journal's Heard on the Street. I mean, Stephen, when you talk about a company that just goes public at a valuation that's greater than some of the biggest traditional automakers that we know in this world, what exactly does that ring in terms of your mind about what's happening in the entire auto industry?
Well, it's a great question, and thanks for having me on the show. I think the key thing here Rivian is the most extreme example of this trend, having, as you said, only gone public last Wednesday, almost exactly a week ago. Today it priced, and its shares have doubled since, so its market value has doubled. And I think it says, for one thing, that people believe very seriously in the challenge to Detroit, because that market value can only make sense if Rivian takes quite a lot of market share from GM and Ford. But the interesting thing is, we're not really seeing the valuations of GM and Ford come back. So there's obviously a bit of a cognitive dissonance here. And I think this is best illustrated by the fact that 2 years ago, the total valuation of the top 10 automakers in the world, excluding China, so the top 10 global automakers, was about $680 billion, and now it's over $2 trillion. So it's tripled. The market value of the top 10 has tripled, and it's hard to see that the earnings potential of the very mature car industry has tripled. It's possible that EVs might be a bit more profitable in the future. At the moment, they're less profitable for most people. So you can see how people might think, oh, maybe it's worth a bit more. And there's a story about software, self-driving software that might add a bit of margin to selling a car, which has traditionally been a pretty low margin business. But to say that the earnings potential has tripled, that's a real stretch.
So Stephen, that brings up an excellent point here, but the idea that we often compare many of these auto stocks, these EV stocks, to other auto stocks, other auto companies in the industry, or to internet companies, or to battery technology companies. What exactly then becomes the fair way to look at the comp or the comparable for what these EV companies are going to be?
Well, I think that's the really difficult question, and some investors, the bears, prefer to look at Tesla and say it's worth 4 times Toyota. That's crazy, and the bulls say no. If you look at its targeted 50% growth a year, that's at the upper end of tech company growth profiles, and therefore it all sort of fits. I think ultimately Tesla's valuation starts to make sense only if you think of it achieving its target of making 20 million vehicles a year in 2030, which is something that Elon Musk said last year, and at pretty good margins. And if you kind of think, 20 million vehicles at a 15% margin, which is what it made in the third quarter, roughly, operating margin, then the 1.1 trillion valuation starts to make a bit of sense. But I think that the problem is that investors are already rushing ahead and forecasting this scenario, which is, it's possible, but it's subject to huge uncertainties, and obviously the intense rivalry with GM and Ford and all the rest of them,
sure,
and Toyota. And so I think, there's just a tremendous amount of uncertainty around, so which makes the tripling of valuation of the big automakers even more sort of hard to rationalize.